Hello, welcome back ACCA Moxie students. I'm Neeraj Sen, ACCA. So today our topic is economic environment for business. So a good financial manager is one who take decision after considering the environment around his business. Okay. So while making the decisions, you have to consider the environment because the environment affect our decisions. If you have the good road and if you have the park around yours in your society locality, and that affect all your neighbor and you, okay, that affect all of us. But if you have any disagreement with your family, then that affect only your family, that within your family. Okay, micro and the macro. Macro is within and affect only you. Okay, but macro is outside around us and affect all of all of us. Okay, all of us. So the macro environment affect all the people. Okay. So the environment that we will consider here is the economic, which means the money. Okay. So in this chapter, we will understand the macro environment and their objective. Okay. So macroeconomic objectives. Okay. Then we will understand the conflict between these objectives. Then next we understand how the government make the policies to achieve these objectives. Okay, so government has to make the policies, and sometimes they have to intervene and regulate the things in order to achieve these objectives. So if the government wants to achieve these objectives, so macroeconomic objectives, so government has to make the policies and intervene and regulate the. So we have the three policies here, that is the monetary policy, fiscal policy, and the supply policy, and the supply side policies. So we have the three policies here, and some interventions and regulations are like competition policy. So when you have the monopoly situation in the country, so government make the competition policy, and when the government run companies are not doing well, so government has to intervene and sell those entities and make the privatization. Okay, so these are competition policies, privatization, and government assistance, like government give some assistance. Okay, so next is the green policies. Government make policies for encouraging the environment friendly products or methods of producing the products. And then we have the sustainability. Next we have the corporate governance. Okay, how the companies will govern. So these are the policies and interventions done by the government. So this is the whole chapter that we will understand. These are the topics that we will understand here in this chapter. Okay, we have the introduction of macroeconomic policies. Okay, so what is macroeconomics? Macroeconomics is the branch of economics that deals with large scale of general economic factors. So macroeconomics consider the factors that are at the national and global level. Okay, so those factors which affect the whole country or at the global level. So macroeconomics consider that. Okay, so macroeconomic policies. So what is macroeconomic policy? Macroeconomic policy involve management of economy by the government in such a way as to influence the performance and behavior of the economy as a whole. So you manage the economy, and that management is done by the government in such a way. Government manage economy in such a way that influence performance behavior of the economy as a whole. Okay, so these are the policies. So government make the policies that affect Macroeconomic policy means management of the economy that by the government in such a way that influence the behavior of the economy, that influence economy as a whole. Okay, so these are the policies, and the framework is critical for business planning to predict and construct. So these policies and these framework, these policies are important because we need to understand these policies, because if we understand these policies, then we will able to understand these policies, then we can make the good decisions. Okay, because because if government reduce taxes, then this affect our business. Okay, if government increase taxes, that affect our decisions in the business. Okay, so that's why we have to understand the economic policies, macroeconomic policies. Next is, what are the objectives? So government objective is, what is the objective of the government? If this is the government, this is the government. So government objective is, these are the citizens. So government objective is to make people happy. Okay, make the people happy. That is the objective of the government. Okay, be happy. So when you get money, you will be happy. Okay, when you get money, you will be happy. Okay, so but how you get money? When you work, you will get money. Okay, when you work, you will get money. Okay, when you work, you will get money, and when you get money, you will be happy. Okay, so government objective is to give employment to those people who wants to work. Okay, so full employment means those people who wants to work get the work. Okay, applies in particular to labor force. Aim is to both full and stable employment. It means that full employment means it is full employment. Those people who wants to work will get work, and those who get work, they not laid off. Okay, they not laid off later on. Okay, so it's stable employment. That is the objective of the government. Another objective of the government is stable price stability. It means the no inflation, no inflation. Okay? No, sorry, no inflation. Price stability means low inflation. Okay, means little or no inflation, putting forward prices on the pressure on the prices. So if the inflation rises, so price will increase. Okay, if the inflation rises, price will increase. So government objective should be that the inflation should be low as much as possible. Okay. So next is the economic growth. Another objective of the government is economic growth. Okay, economic growth. So when the economy grow, which means that there is, when the economy grow means aggregate demand will grow. When the aggregate demand will grow, increase in employment. So increase in employment means people will get more money, and which means ultimately they will be happy. Okay, national income is the aggregate demand, you can say, from year to year. And this, when the economy grow, the living standard will grow, because you get the job, you get the money, so definitely your living standard will grow. Okay, so next is the balance of payment equilibrium. Balance of payment is what, how much you export, how much is the export, okay, and how much is the import. Okay, so if this is export is higher, so that is surplus. If this export is lower and import is higher, which means you have the negative value, and that is the deficit. Okay, deficit. So the government objective is to make the export and import at it means make the export equal import. But this is very difficult situation. So in a country, you can never be export is equal to import. There is some deficit or surplus always. And if this is deficit, then you are importing more, so you have to pay money. So you have to pay money, and how can you pay? You have to borrow. So government has to borrow the money. So government has to borrow the money, and then government has to pay for the import. Okay, so that is the very dangerous situation. That is very bad situation. So a government should have the surplus or at least the equilibrium. So the balance of payment equilibrium is the objective of the government. Next is the distribution of income and wealth. So the distribution of income and wealth should be equal. Okay, equal distribution of income and wealth. Okay, so government will try to manage that there is no big difference between rich and poor people. So government will put higher taxes on rich and lower on poor, or give good or like home to the poor people. Okay, so that there is no big difference between rich and poor people. Okay, so so now we have to understand the conflict between the objectives. Okay, so before I explain the conflict of objective, we have to understand this aggregate demand. What is aggregate demand? Okay, so aggregate demand is the demand for goods and services in the economy. Okay, so aggregate demand is the overall demand of the country. Okay, so this demand is the overall demand. Okay, so let's draw one diagram here. This is y-axis. This is x-axis. This is the price. And if you have studied the economics in your earlier study, so you know that this is the price on the y-axis and this is the quantity. Okay, this is the quantity. And how is the demand and supply curve draw on this? So this is the demand curve and this is the supply curve. Okay, this is the demand curve, P0, and this is the supply curve. Okay, and this is the point where the price will be set. Okay, as per demand and supply rules. Okay, so when you have the demand and for the same product you have the supply, so there is a point where you will set the price. Okay, so what happens if this demand is this aggregate demand, let's say this aggregate demand and this aggregate supply. Okay, it's the overall demand and supply in the country. So what happens if the overall demand, if the demand in the country increase? Okay, if the demand in the country increase. So demand in the country increase, what does it mean? It means that economy is growing. When the economy grow, the demand for the goods and services grow. Okay, so this is AD1, AD1. Okay. So when the economy grows, the aggregate demand will grow. And when the demand will grow, the supply cannot grow as the same level as the demand grow. Because in the short term, when the demand grow, we cannot supply, we cannot increase the supply because of our restrictions, because we don't have the resources, like we don't have the enough factories to produce that. When we don't have the enough factories to produce, so we cannot increase our supply in the short term. Okay, so that's why our demand will grow, but our supply will not increase as much. So what happened that now our prices will increase. And you know that prices increase means inflation. Okay, so prices means P0, P1. And when the price increase, this price increment is called the inflation. Okay, so that is the problem that we face when we grow the economy. When the economy grow, the inflation will increase. Okay, so this is the problem. So when the aggregate demand is high, the inflation will be higher. Okay, so when the increase in economy, increase in inflation. So that is the conflict between the objectives. Okay, so if the demand is low, when the demand is low, like here. Okay, so here, if the demand is lower here, so AD minus 1, AD minus 1. Okay, so when the demand is lower, that will reduce the supply. Okay, so that will reduce the supply and reduce the price. Okay, when you don't have the demand, if nobody wants to buy the television, okay, nowadays that is the television market is like in the downfall. Okay, so if nobody wants to watch the television nowadays, so the demand for the television will reduce. Okay, will fall. When the demand for the television will fall, then the price will definitely fall, because nowadays you see that so many companies are selling cheaper televisions, because there is no demand for the televisions right now, because everyone is watching whatever they like in their mobiles and laptop. So nobody wants to watch anything in the televisions. Okay, so the price is also decreased. When the price decrease, that means that there is no the demand decrease. When the demand decrease, the company will not produce. So companies will not produce. Production will reduce. When the demand reduce, the production will also reduce. Okay, so the production reduction means the supply will be reduced. Okay, supply will be reduced. When the supply will be reduced, which means that there is no need of employees. So employment will be reduced. So there is no need of employees. So there is high unemployment. So impact on the business. What is the impact on business? Changes in aggregate demand affect all the business. Yes, it's the aggregate demand. That's why it's affect all business. Effective planning requires predicting policy thrust and its consequence on business. So we have to analyze the consequence of that aggregate demand on the sale. Okay. Stable government policy make it easier to plan investment, employment, and future capacity. So if you have a stable government, then you can easily plan the investment, employment, and future capacity. Okay. Between these objectives, there are conflicts. If you achieve the full employment, that is the objective here. So the price stability will be compromised. which means that if you increase the employment, so people, if you increase the employment, which means that full employment, if everyone is doing job and everyone is getting money and earning money, so what happened that this increase the inflation, why? Because the when people have money, they increase the aggregate demand. We have already studied here. So when the people have money, when there is full employment, the aggregate demand will be higher. When the aggregate demand will be higher, in the short term, we cannot increase the supply because we have the limited factories to produce the products. Okay, so that's why we have to increase the price. And when the price will increase, this means that inflation will increase. Inflation is higher. Okay, so that will employment will create the inflation. So the inflation and employment are inversely related. So achieving full employment may lead to excessive employment caused by excessive aggregate demand. We have already understood this in the diagram. Okay. Next is economic growth. When we increase the economic growth, when the economy is growing, what happens? The balance of payment deficit will increase. Okay, balance of payment deficit will increase. What does it mean? It means that your import is higher than your country export. Okay, so that is balance of payment deficit. So why increase in economy create the balance of payment deficit? Because when the economy increase, aggregate demand will increase. When the aggregate demand will increase, you have to supply that product, but in the short term you don't have the enough factories, enough labor. So in order to fulfill the demand, you have to import that product from the outside country. Okay, if the policy is incompatible, so if the government policy is incompatible, so this will damage the government reputation and the business confidence that they are facing. If the government apply inappropriate tax rates, then the business will suffer and the government reputation will be damaged. So the policy must be very appropriate, that must be compatible with the business environment. So the policies are monetary policy, fiscal policy, and supply side policy. So first we understand what is monetary policy. Monetary policy is managing the volume of money in circulation. Okay, so monetary policy is managing the volume of money, how much money is circulating in the economy. So you have to manage that, and that management policy is monetary policy. So monetary policy is concerned with including the overall monetary conditions in the economy. Okay, so when we control, there are two types of control: direct control and indirect control. Direct control is this managing the volume of money in circulation. So when you manage or alter the volume of money in circulation, it is called the direct control. When you control the money supply, that is called the direct control. But when you control the interest rate, that is called the indirect control. Because if you want to control the money in circulation, so either you have to buy or you have to print currency. Okay, you have to print the currency. So this task is very difficult for the government, and it will take so much time. So that's why controlling the interest rate is very easier. So when you increase the interest rate, when you raise the interest rate, so that will discourage the expenditure, because the cost of credit, the cost of borrowing, cost of borrowing will increase. When it will be additional expense for the companies who wants to invest in the project. So when the company try to invest, so they have to incur the additional cost of borrowing. That's why they discourage the investment, and they will wait for the reduction in the interest rate, and maybe they will invest in the future. So that's why it discourages the expenditure. And the interest rate smoothing, what is this? Interest rate smoothing means you increase, if for example government wants to increase the interest rate, that is 8% per annum, and wants to increase the interest rate to 10% per annum. So instead of increasing 2%, instead of increasing the 2%, by one go, instead of increasing 2% in one go, they will try to split that 2% on the 4 quarter. Okay, on the 4 quarter. So government will increase 0.5% every year. So in the first quarter, the interest rate will be 8.5, and the interest rate is 9%, and so on. So government will increase 0.5% every year instead of increasing 2% in one go. Okay, so that is the interest rate smoothing. So why the government do these type of things? Because of the economy, because avoid instability. Because if you want a stable economy, so you have to increase it slowly, so then you can analyze the effect, and then later on you can increase it. If it is good, then you can increase it later on, but if it is bad, then you will stop that. So that is the main reason. Another is the political reason. Let's understand the impact of monetary policy on business. Okay, so monetary policy is money supply and the interest rate. Okay, so these are the factors that are affected if you change the money supply or the interest rate. So let's say, for example, you are controlling the money supply. Controlling means reducing the money supply. Okay, reducing the money supply, and this is increasing the interest rate. Okay. So what is the impact on availability of the finance? So if you reduce the money supply, so if you have the lower supply of money in the economy, so which means that your credit, which means that businesses are struggle to raise finance. Okay, businesses are struggle to raise finance. Cost of finance is affected when you reduce the supply. That will push the cost of funds, and discourage expansion. Okay, so if you reduce the money supply, so you have the limited supply in the economy. So if you have the limited things, so that's why the limited things become expensive. So this definitely means if someone wants to borrow money, for the investment, so that borrowing will be costly. So if the borrowing cost will increase, so the companies will discourage the expansion or discourage the investment. Okay, so this is the impact. And what impact if you increase the interest rate? If you increase the interest rate of borrowing, so then the availability of finance, difficult to raise funds, difficult to raise funds because of increase in the cost of borrowing, because those people who cannot afford this higher cost of borrowing, so they will definitely not take the borrowing. Okay, if the borrowing cost increase, so the shareholders return should increase. Because, for example, if your younger brother get gets get a gift from your dad, so if your younger brother get a gift from your dad, so next day you will go to your dad and say, I want the gift as well. So the level of consumer demand, saving becomes more attractive, spending less attractive. Because when you spend money, you have to borrow, and when you borrow, so that borrowing will cost you higher. But what happens when the interest rate for the borrowing increase, which means the income for the bank increase. When the income for the bank increase, so the bank will also increase the interest rate for the deposit. Okay, so if you are getting higher money, so you will give higher money to the depositors. Okay, so if and the higher exchange rate attract foreign investment. So if the deposit interest rate will increase, so foreign investors will try to deposit in your country's bank account. So that will increase the exchange rate. Because if you want to deposit, for example, if your country is UK, so you have to deposit, if you want to deposit money in the UK bank account, so you have to deposit the British pound. You have to deposit in the account, in the bank account. And when you deposit, how can you deposit? You have to sell your US dollar if you are from USA. So you have to sell your USD and buy the pound, UK pound. And when you buy the UK pound, the demand for the UK pound will increase. When the demand for the UK pound will increase, the exchange rate for that for the UK pound will increase. Okay, so when the exchange rate will increase, the export become expensive. And import become cheaper, because your country UK pound is stronger, so you can buy cheaper products from outside. Okay. Next is inflation. Inflation is the general increase in prices over time, leading to a decrease in purchasing power parity. So inflation is increase in the prices of the product, And what it does, it means that last year, for example, 1 British pound can get 1 kg of banana. So now this is previous year, this is current year. So now this year, 1 British pound can only get 700 grams of banana. Okay. So which means that you are getting less banana out of the same money. So by paying the 1 UK pound, you are getting the lower banana, only 700 kg. So your loss is 300 gram. 300 gram is your loss. So that means that your purchasing power of the money has decreased. Because, and what is demandful inflation? When the demandful inflation is when there is excess demand in the economy, when there is excess demand in the economy, so you know that when there is high demand, and there is not sufficient, and when there is not sufficient supply, when there is not sufficient supply, so what does happen? The price will increase. When there is no sufficient supply, then the price will increase. When the price increase, that means the inflation increased. When the price increased, it means the inflation has increased. Okay. Next is cost push inflation. Cost push inflation means higher production cost. If because of higher prices, your cost of production, your cost of raw material will increase. When your cost of raw material will increase, your production cost will increase, and this production cost will definitely increase the price of finished product. And when the price of finished product increased, that means that is the inflation in the economy. Okay, that is the inflation in the economy. See, fiscal policy is about the tax revenue and the expenditure. Okay, so how much tax you want to collect from the citizens, and how much you want to spend on the road construction or like park, school. These are the expenditures, and how much you want to collect. Okay, so fiscal policy cover the government spending, taxation, and the government borrowing. Okay, borrowing, I will discuss this later. Okay, so our job is that in this policy we will consider that we will try to balance the tax revenue and the expenditure. But what happens that either we spend more or we spend less. Okay, so we want our job as a government in this fiscal policy is that the total revenue, the tax collected, must be equal to expenditure. That is the our aim of this policy. But this is not possible generally, because either you spend more or you spend less. Have you ever been on traveling? So for example, if you have a budget of 1000 UK pound, but generally you spend more, like 1200, or you spend less. Okay, but you definitely not gonna spend the 1000 exact amount. Either you spend more or you spend less on the traveling. So if they spend more, then that is the deficit. So the government will be in deficit fund. But if the government spend less, then the government had surplus funds. Okay, so this deficit that you spend has to either you have to borrow from someone, either government also has to borrow this amount somewhere. Okay, because he has spent more money. So public expenditure is the tax raised plus the borrowing. So this is the equation here. Next is problems with the fiscal policy. So there are some problems with the fiscal policies. So we have to understand here. The problem is financial crowding out. Financial crowding out is when the government spend more. So government has to borrow. Okay, so government has to borrow, and when government borrow, so this increase the demand for the money. Okay, so because government borrow in very large amount. So government requirement of borrowing is also very high. So when the government borrow in very high amount, and this increase the demand for the money. When the demand for the money increase, the bank will charge higher interest, and this higher interest will mean that the cost of borrowing for the companies will increase. Okay, so cost of borrowing for the company will increase. When the cost of borrowing for company will increase, which means that they don't invest somewhere, they don't invest in the new factories, and they don't invest in the new products. So this will fall in the private investment, and this hurt the long term economic growth. So this will definitely hurt the economic growth. But what is the exception? Exception is that during the recession, so the private investment is all already they are already not investing somewhere. That's why the economy is in depression, because the private players are not investing. So government has to step in. When the government has to step in, then government spend money. When the government spend money, like boosting the economy. So how government spend money? So government gives some grant or reduce the taxes. Okay. So when the government spend on the construction project, on the construction like road, and when the government build good roads, then this will increase the economy, because for making the roads, you have to buy the raw material. When you buy the raw material, this will increase the income. This will be income for the raw material vendors, and this income will definitely increase the economic growth. So another is incentive effect of taxation. Taxation tax alter patterns of consumption and economic growth. Yeah, consumption and economic activity. When you increase the tax rate, tax is the revenue for the government, and government always wants to increase the tax. So what happen? This increase will impact the consumption and the economy activity. So high excise duties on alcohol and tobacco, like when the excise duty on alcohol and tobacco increase, what happens? That the demand for that tobacco and alcohol products will reduce. So reflect social and health policy priorities. So demand for these products will reduce, and people will try to focus on their health and social environment, because these consuming alcohol and tobacco is not considered as a good thing in the society. So they will focus on their own social priorities and the health priorities. Okay. Next is the excise duty on petrol. So when the excise duty on the petrol will increase, so discourage excise duty. Excise duty is one type of tax. Okay. So when the excise duty on the petrol increase, so this means that those car owners who want the petrol will discourage using the cars. Instead, they will discourage private cars used due to environmental effects. Because if you increase the petrol price, people will try to discourage their own car and use the public transport. Okay. So that will be another effect, and that public transport is definitely the environment friendly. And steeply progressive income. And when you increase the taxes on richer when you have high income, when your income increase, your tax will increase. So this act as a disincentive to work. So people will not try to earn more, because if they earn more, they will have to pay more tax. Okay. Employer national insurance raise the cost of labor and probably reduce the employment. Okay, so that is the insurance. That is the, if you mandatorily, if you done the mandatory insurance of the employees, then your company has to do the mandatory insurance of their employees, and this will increase the cost of the labor, and this will reduce employment, because you cannot afford more employees in your company now, because the previous employees that you already have now become expensive. Now we have the supply side policies, and we have studied that this is the y axis, this is the x axis, this is the price, and this is the quantity. Okay, this is the demand curve, this is the aggregate demand curve. Okay, and this is the supply curve. And what happens when the demand increase, the supply don't increase as much. Okay, when the supply don't increase as much, so what happens that our price will increase. Our price will increase. Okay, so when the supply remain here, when the supply don't increase, or supply only increase at very like only here, not so much. So now you know that supply only increased this much, but the demand increased this much. So if supply only increased very few, less than the demand, when the supply increased less than the demand, so you know that the price will increase. So before the price was here, now the price is here. Okay, now the price is here. So now you know that now the prices has increased. So one solution is that you increase the you reduce the demand, okay, or you fulfill the supply. So you fulfill the supply by import, or by taking these decisions. You can increase the supply in your own country in the privatization, because you know that when the government do something, government takes so much time. If government build a building, it will take 5 years. But if someone private builders build a building, build a tower, residential building, for example, if government build a residential building, it will take 5 years. But if the private players build the building, that it will only take 2 years, because they try to engage more labor force, and they increase the working hours. So that's why the efficiency for the private companies increase. So what happened? The government expose the government run companies. The government run companies now sold to the private investors, okay, private players. So when the private companies buy the government run organization, the competitiveness will increase and the efficiency will increase, because they are now only completing the building in two years instead of the 5 years. Okay, so this means that the supply, they are only building one building here in the 5 years, they can build two more than two buildings in 5 years. So this means that the supply now has increased. So this is the supply side. Another example is the fiscal tax incentive. So when you reduce the tax, this encourages the small investors to invest in the new, to build new companies, to start new companies. So when you reduce the taxes, so the small players who wants to invest in the companies, so they will start their own companies. So for example, 5 year no tax, 5 year no tax on the startup. So there will be so many startups in your country if there is no tax for the next 5 years. Okay, so these startups will produce the product and will increase the supply. Okay, this will increase the supply. So this is the another supply side policy. Okay, another is infrastructure, that government spend on the infrastructure. When you have the good road, when you have 24-hour electricity, and when the foreign investors see that your country has good road, good electricity, for example, like China, in China, you have fast train, good road, and you have the 24/7 electricity. Okay, so these are the main factors that is why foreign investors are attracting inside the China. Okay, so that is the main reason that government spend very high on the infrastructure. And when the government spend very high on the infrastructure, that will increase the investment in the country, in the business, and those business will produce goods or services. When they produce the goods or services, this will increase the supply in the country. Okay, so this is the supply side policies. We're going to study the more steps that the government will take in order to increase the economic growth. So what are these steps? These steps are like intervention and the regulations. Okay, so when there is any problem in the market or in the economy, so government take some steps that are intervention and regulations. So these are the steps. Government intervene and regulate the market. Okay, so government regulate business in case of market failure. Okay, in case of market failure, the government regulate the market. Okay, and where the market performs inefficiently, and also where if the market is performing inefficiently, then the government step in, and the government make some regulations. Okay, so result in negative economic consequence. If the market is inefficient, then it will definitely impact the economic growth. Okay, so if the market is inefficient, then inefficient market means it can be monopoly. So one of example is monopoly. So monopoly is a very bad situation in any market, in any of the country. So monopoly means only one seller. And if there is only one seller, so he can or she can charge any price. So any price. So he can charge any price. Okay. And there is no innovation, because you are the only seller in the economy. So if you are only seller in the market, so you don't innovate. So you only sell whatever you want. Okay, so that's the problem when you have the inefficient market. And inefficient market example is the monopoly. Okay, So when you have the monopoly, what the government do? Government makes some policies that is like competition policy. Because of the monopoly, there is no competition in the market. So government make the competition policy to increase the healthy competition, to increase the healthy competition. To increase the healthy competition in market. Okay. Privatization. So these are the steps government take in order to increase the economic growth. Okay. So one is the competition policy. Government make the competition policy to increase the healthy competition in the market. Okay. Next is the privatization. If any organization is run by the government, so that organization is definitely inefficient and the productivity is lesser than the private organizations. So what the government do? Government make some make the sell the government run organization. Tell the government run organization, and the government run organization will now become the private companies. Okay. So if the government run organization become the private companies, then this will improve the productivity. Provision of government assistance. If the citizens don't have enough funds to start new company. If the citizens don't have enough funds to start a new company, then government step in and give some government grant. So government provides some funds. Government provides some fund or grant. You can say some amount or subsidy like no tax for 5 year or some amounts. For example, if you are a small business, then government give you $100,000 to start a new business. So this type of amount is called the grant subsidies for the people. Okay, for who wants to start a new business. Next is the green policies and sustainability. And when you increase the economic growth, and you set up new factories, and when you start a new factory, when you start a new business, then you have to cut the trees, you have to build the factories. Then when you produce, you have to process the products with the water. You have to release the carbon in the air. So these all make the environment, our environment, polluted. So when these our environment will become polluted, then the government has to make the green policies. So for example, you cannot use more than, if you have a factory, for example, you cannot use more than 5,000 liter water in a month. Okay, so you cannot use more than 5,000 liters water in a month. So this type of policy, and you cannot emit carbon without the filters. So you have to put filter process process the emission. Okay, so these are some of the decisions government has to take in order to make the green policies. and make the environment sustainable. Okay. So managing environmental externalities. Corporate governance. Corporate governance is made so that the business follow ethical business practice. So what happened is that when the government, because you know that principle, you know that owners owners invest money, invest, and the directors from the company. And this is called the principal. This and these are called the agent. Okay. So because they are running the company, so they run the company for their own benefits. So for example, increase their own salary. Instead of making the profit, they increase their own salary, and and they don't make any profit and don't distribute any amount to the shareholders. So this is one of the example that the agent work directors work in the benefit of their own interest rather than the benefit of the owners. So when this happens, the government has to make the corporate governance. Because of these problems, because of the agency and principal problems, you have a lot of scam. So you have a lot of scam in the past, like and Enron. Enron is one of the scam, and because of these problems, government government has to make the corporate governance policy so that business perform in an ethical way. Then some of the advantage and disadvantage of the monopoly. A monopoly is where a firm has sufficient market share. So if you are the monopoly, you have the sufficient market share to restrict the output. So you can manipulate, you can restrict the output and raise the price. Okay, so you can produce whatever volume of amount you want to produce, and you can even raise the prices because you are the only seller. Okay, so that's the situation. If you can restrict the output and you can raise the prices, then that situation is called the monopoly situation. Okay, what are the some advantage and disadvantage of that? The one of the advantage is that when, for example, if you are the only seller or the shoes, so everyone will buy from you. When everyone buy from you, so you are selling the highest. You are selling lots of unit, lots selling lots of unit. So you are selling quantity is high. When you sell lots of quantity, then you can produce at cheaper rate because of the economies of scale, because you can buy raw material in the bulk quantity. When you buy the raw material in bulk quantity, so you will get the better price, and you don't need to set up the machine again and again. That will save your cost further. So it means that when you produce in high amount, you are in the economies of scale situation, which means your cost per unit will be lowest. Your cost per unit in the market will be lowest. Okay. Another is that natural monopolies. Another advantage, efficient for basic infrastructure, energy, water, and where one producer is feasible. Natural monopolies. Generally, the government of the country hold the monopoly on the natural resources. So these natural resources are limited. So government hold the monopoly position, and this monopoly is good for the citizens because when the government hold the monopoly, government usually sell these products, they sell these goods and services at very low price. So this kind of monopoly is beneficial for the citizens. Okay. So next is research and development. When monopoly profit, when you are in the monopoly, so you make lots of profit, and when you make lots of profit, so you can use that profit in the technology or innovation. I said you can use, but what generally happen, you generally don't innovate. But why you don't innovate? You don't innovate because you know that your product will be sold, and product will be sold because you are the only seller. When you don't put so much effort to innovate your product, so you just keep producing that product for so many years. So that is the lack of innovation when you are in the monopoly. And when you are in the monopoly, because you are in the monopoly, so you also become inefficient. What does inefficient means? Inefficient means you don't, you don't, you don't, you don't buy, you don't buy, you don't buy new machine to reduce cost per unit. Because when you buy new machine, new technology, your cost per unit will reduce. And because you are in the monopoly, so you don't focus on the cost reduction, because at whatever price you produce, if you are producing at 10 pound this year, so you can easily sell at 12. And if you produce even at the 15 next year, if you produce at 15 pound next year, you can easily sell this at 17, because whatever price at which you produce, you can easily sell because you are the only seller in the market. Price discrimination is when you are in the monopoly situation, you can sell the customers at very high price or even at the low price. So for example, if you are the seller of umbrella, okay, so in case of rainy season, you are selling the umbrella at 20 pound, okay, 20 pound. But in case of non-rainy season, in case of winter or summer, non-rainy season, you sell these umbrella at only 10 pound. Okay. When in the rainy season you are selling 20 pound, but in case of non-rainy season you are selling at the half the price, that is only 10 pound. So that is the price discrimination because of the monopoly. So another is the predatory pricing. Prices practice make it uneconomic for new firms to enter, because the monopoly firms, the monopoly producer are in the situation that they can produce at very high quantity and at very low price because of the economies of scale. So when you want to compete, when outsiders compete with the company, when the outsiders compete with the company, so what the monopoly company do, reduce the price. That is very low. So for example, this umbrella, now they start selling at only 2 pound. Okay, when you start selling the 2 pound, you can still making some profit or even not making the profit. But for the new entrant, this $2 pound price is very difficult to offer for the customers. So that's why the price That's why the new entrants cannot enter into the market, because there is one note here: economic welfare is generally maximized when markets are competitive. So economic welfare. So if you are in a healthy economic environment, so that is generally considered as economic welfare, and the markets are competitive. So when there is competitive market, there is innovative product, there is less price discrimination, and the economic environment will be friendly, and you can say that economy is welfare of the citizens. Government response to monopolies. In order to control the monopoly situation, now government will take some actions that will eliminate the monopoly situation in the market. Okay, so there are three decisions that will government take here: the public provision, next is regulation, and the control. Okay, so these are the three decisions. In the public provision, what the government do? Buy government will buy the private organization. Okay, now the government will buy the private organization, and the government will sell the now the government will sell the products at cheaper price, that is at the fair price. So we understood that the umbrella seller is selling the umbrellas in the rainy season, that is 20, but in the summer or non-rainy season it is only 10 pound. Okay, and this unfair price will be eliminated by the government. If government started manufacturing the umbrella, so then government will only sell the umbrellas at only the pound, UK pound, GBP 10. Okay, government will if the government will buy the private organization, that will be the fair price. And nationalized activity means the government will buy the private organizations. And you know that when the monopoly situation, when the government will buy these umbrellas, then the umbrellas will be produced at very high quantity, and the government will also achieve the economies of scale. So government can produce at a lower price. Okay, but the problem is that when the government do something, there is always an inefficiency in the government work. When the government takes so much time, and generally government work is usually inefficient. So this is the one of the problem. So the next is the regulation. So the government put some regulation measures like self-regulation and the legal regulation. Okay, so self-regulation is like we have the ethics. Paper in our exam, in our ACCA. So audit and ethics you have studied in your ACCA exam, that tells you that you have to be objective. So you should keep away from any personal bias, and you should not take money from the client, and blah 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 blah. That's all about the ethics, and you have to follow the ethics. So these are the principles, but these are not the mandatory. These are the principles you should try to follow. So ethics are you put on yourself, not anyone come and forcefully put on you. These companies also believe in the self regulation. So some companies make the policies like the fair treatment of the employees and fair treatment of the environment. So these are the policies of the companies as well. But if these companies don't follow, then the government will take action against these companies. So how the government take actions? Government make the rules against the violators, and police catch you, and then you have to go to court, and court will decide the penalty. And companies don't follow the environmental rules, so some penalty to the government against the violations. Okay, so these are the legal regulations. Next is the control of monopolies. So government also control the monopolies like legal restriction against like legalization against the restrictive practices. If legalization against the restrictive practices, and you know that the monopoly companies can charge whatever the price they can. Okay, so usually the monopoly companies can charge in or increase the price whenever they can. Okay, so these type of situations can be restricted and making the price fixing or price increasing illegal. So government make some regulations that if you fix the price in like summer and in the rainy season, that will make that price fixing is illegal. So government make some regulations for that. Okay. So another is the review of all potential merger and monopolies. If there is any monopoly in the market, and if you want to buy or merge any other company that is your competitor, then the government will analyze whether the merger will give the new company the monopoly situation. If the merger will give the new company the monopoly situation, then government will say that this situation is not acceptable and your merger may be refused. Okay. The privatization and the government assistance. Privatization is when the government sell the state-owned departments to the private companies. When government sell their companies to the private companies, then it is called the privatization. Okay. So one of the example is the British Rail and Royal Mail. So these are the government companies, but now they are sold to the private companies, private sector. Okay, so this reduces the government spending and increase the tax revenue. When the private companies increase, it means that efficiency will increase. When efficiency will increase, which means that supply will increase, and when supply increase, the economic growth will increase. Okay, economic growth will increase. Okay. Next is government assistance, providing financial grants, subsidies, and expert advice. So government assistance is like when you provide some amount to the new companies, to the new startup, so that if you are a producer of green, like wind electricity. So if you are producing the wind electricity by windmill, so if you are producing the wind electricity by windmill, so government may give you the grant for that because government friendly activity. So that's why government will give you some grant and also subsidies to buy the windmill. Okay. So this is the government assistance. So aim of the government assistance. So aim of the government assistance is that the government wants to boost the enterprise. Government wants to boost the enterprise, which means that government wants more increase in wind electricity companies. So government want more wind electricity companies. Okay. So that's why the government is giving you the assistance. And another is that when you give the assistance, that assistance, these type of companies can use these grant and assistance for the innovation. So for a grant are subject to stringent criteria based on, but these type of grants are given based on the criteria fulfilled. For example, you have to you have to location is like remote rural location. So you have to build your factory in a rural area that will give the village people the job employment, so that their living standard will improve. So sites like you have to give you have to at least employ 200 employees. Okay, industry sector, it could be like bread making, bread making, bread making industry in the remote village that will result in strong competition for the funds. Okay, so these are some of the conditions that you have to open your factory in the remote location, and you have to give at least you have to employ 200 employees, and you have to start a bread making company, making factory in the village. So these are the some of the conditions. If you fulfill these conditions, then you can only get the grant. Okay, so getting the grant is not easy, but if you fulfill, then you can get the grant. Green policy means it is related to environment. It is related to environment. Okay. So the green policies, government makes some policies to protect the environment. So in this we will understand the externalities. Externalities is the cost or the benefit that is not paid or received by the producer or the consumer. Neither the producer pay nor the consumer pay, but who pay for that externalities? So externalities is like pollution, pollution. So these type of pollutions are usually bear by the society. So these externalities is divided into two parts. First is the production externalities, and second is the consumption externalities. So I'm taking the example here. The example is a car manufacturing. If a car manufacturing company produce a car, then when you manufacture the car, when you buy the iron rod, to manufacture the car parts, so that will create the pollution, and when you make the parts, when you further go ahead, and when you make the parts, you will have to clean that part with the water. Car parts, when you manufacture the car parts, so you have to clean those parts before installing it into the car. Okay, so you have to clean that with the water. So you will use water, and when water is very become dirty after you wash the parts of the car. Okay, so that polluted water usually mix with the river water. If this water mix with the river water, that will become the polluted water. The river water will also become the polluted. Okay, so this is the production externalities, or I can say the production external cost. Okay, and the another is the consumption externalities, and when the vehicle emission causing air pollution, and when the consumers buy the car, and when the consumer drive that car on the roads, so that pollution is bear by the society on the road where it is driven by the consumer. So that pollution is bear by the society. So that is the consumption externalities. When you drive the car, you will emit the pollution. When you emit the pollution, you don't emit at your home, you emit on the road, and that pollution is bear by the society. So that is the consumption external cost. Okay, and because private producers, consumers ignore these effects, and generally these effects are ignored by the producers and the consumers. So the standard price system leads to because you ignore these production cost and these external consumption externalities. So the standard pricing system do not include the pricing for that cleanup cost, cleanup cost, cleanup cost, cleanup cost of river, and the air filter, So these type of costs are not included in the standard pricing system, and when you don't include that, will be the misallocation of the resources. So what the government do? Government make the policies, green policies, and government response is that green legislation and punitive taxation. So government will say that whatever you are using. So for example, if you are using the plastic bag, if you are using the plastic bag to manufacture, if you manufactured a gearbox for a car, you manufactured the gearbox for a car, and when you try to sell that gearbox in the market, so you have to pack that gearbox in the plastic bag, and when you pack that gearbox in the plastic bag, and that plastic bag, you have to write how much how much you paid, how much you paid for that plastic bag. You have to account that in your account in the SOFV and PL, in your SFV and PL, okay, in your accounting books. So you have to account this cost in your accounting books. Okay, so how much plastic bags you bought and how much is their price. So you have to account that in your books. Okay. Another is the carbon tax. When you emit high pollution, so government will put carbon tax on your company, on your factory, that if you emit above a certain level, so you have to put, for example, 3000 3000 3000 GBP for above emission of the pollution. So that 3000 must be accounted in the external cost in the books of accounts. Okay, so that is the response of the government. And when the stakeholders like government is one of the stakeholder, and when the government know that your cost is plastic bag cost, plastic bag charges, and carbon tax, these are higher than the stakeholders like government know that you are damaging. If this is high, which means you are damaging the environment. You are damaging the environment. Okay. And also the consumers will get to know that you are also damaging the environment because your external cost is very high. Externalities is very high. Okay, next is the sustainability and corporate governance. Okay, so in order to increase the economic growth, government has to analyze that whether this economic growth is sustainable. Okay, whether this economic growth is sustainable. If you are producing those products which are damaging the environment, like doing so much air pollution, the water pollution, so that is not sustainable, because the future generations of our country then could not breathe in the fresh air. So that's why the sustainability is very important along with the economic growth. Okay, so sustainability means meeting the needs of the present generation without compromising the ability of future generation, which means that you have to only use limited natural resources, and do not damage environment. Okay, protect the environment, recycle business. So how can you protect the environment? So you can start, so government may give grant government may give grant or start recycling business, okay, so that there is lower zero pollution producers or lower carbon emissions. Next is social economic. When you increase the economic growth, it does not mean that you increase the economic growth in the urban areas, but the other areas, rural areas, are not well developed. So the rural areas also be developed along with the economic growth, so that the difference between rich and poor is is not a big difference, so that the income and wealth of the country distributed equally. So next is the corporate governance. When you increase the economic growth, that means it does not mean that you take higher risk. If you take higher risk, that means your company may suffer. If you take higher risk, your company may collapse in future because of some bad decisions. Okay, so that's why the corporate governance role is very important when you want to increase the economic growth. Economic growth does not mean that you take high risk and you don't care about the stakeholder, you don't care about the owners of the companies who provide the finance to you, that are the shareholders, debt holders. So you have to take those decisions that are manageable, that are not high risk, not highly risky. Okay, so that's all about this chapter. In the next video, we'll solve the questions based on this chapter, and stay tuned for the next video.
Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.